A stock market crash is something that lots of investors fear. I mean, 2019 we had the yield curve invert, which is a signal of a recession. We have the Warren Buffett measure that is really high, telling us that stocks are highly priced. And we also have certain experts that are out there predicting a recession. In my personal opinion, I think there is about a 50% chance of a recession in the next year or two. And people keep trying to say, oh, I'm out there predicting a recession. I'm not predicting a recession. I'm just saying that there are certain indicators used by experts which say there is a possibility of a recession occurring. So the question becomes, how do we prepare for one? How do we prepare for a stock market crash? Which is the question that I wanted to address in this video. I use 4 key methods to prepare my portfolio for a recession, and I wanted to divulge those methods in this video. These methods, they are not guaranteed to make your portfolio increase when all stocks have dropped by a lot. That's actually ridiculously hard, but what they will do is they will ensure your portfolio is more protected, and that way in the long term you will profit from a recession. Okay, so the very first question that we should ask ourselves is there a particular group of stocks that do better than others in a stock market crash? Well, yes there is. Not just one group, but actually quite a few groups. But the one that stands out to me, and I'm going to divulge it here, is the Dividend Aristocrat group of stocks. And I've talked about this a few times on my channel before, but this graph is so important that I think it is appropriate that I talk about it multiple times. And basically what this graph shows is the returns that Dividend Aristocrats have got versus returns that the market has got over the S&P over the past 30 years. And guys, for those who don't know, Dividend Aristocrats are just stocks that have increased their own dividends for 25 years or more. So basically what they are is just reliable dividend paying stocks. Now, essentially there's 3 points that I would like you all to take from this graph. The first is that over the long term, Dividend Aristocrats have achieved a higher average return than the stock market, 12.1% compared to 9.8%. The second thing to note down is that it's achieved this at less risk, okay? Volatility is 14.2% compared to the market's volatility at 17.4%. So a higher return and less risk. Note down these 2 key points. But also with Dividend Aristocrats, we must notice that they perform really well compared to the market in times of recession. So if we look at the .com recession, we can see that Dividend Aristocrats well beat the market. It beat it by 19.2% in 2000, 22.7% in 2001, and 12.2% in 2002. And in the housing recession in 2008, Dividend Aristocrats well beat the S&P 500 by 15.1%. Very important to note down is that in tough market conditions, Dividend Aristocrats perform really well compared to the market. And why is this? Well, because people want to rush to safety in tough market conditions. One of the things that they look for is stocks that have a reliable dividend payment, e.g. Dividend Aristocrats. And this is what makes Dividend Aristocrats perform better than the overall market in recession periods, because people rush to those types of stocks. And it doesn't just beat the market, it well outperforms the stock market, 19%, 12%, 22%, 15%. Those are not just menial numbers, they're big numbers that it beat the market by. It's not like it performs well in a recession, okay, because all stocks are going down, but it beats the market. So one way you can help protect yourself in a market crash is by having a certain portion of your portfolio in Dividend Aristocrats, or just safe dividend paying stocks. Yeah, stocks with safe balance sheets, strong balance sheets, and a strong moat as well. Quality businesses with little debt that keep paying off that cash flow. Quality stocks to own in a recession. Anyway, I'll quickly show you where you can find all of the Dividend Aristocrats in the S&P 500 so that you guys can go look deeper into some of these stocks. basically what you want to do is just type in Dividend Aristocrats in on Google and then click on the suredividend.com website. Okay, wait for it to upload a bit, and then what you want to do is scroll down until you reach the list. And basically what this list shows is the 57 Dividend Aristocrats. So you got the likes of J&J, you got the likes of McDonald's, Pepsi, Walmart, and other stocks who have continually increased their dividends for 25 years in a row or more. Gold and silver. Okay, this is what's known as a hedge against a stock market crash. And I'm guessing you guys know what a hedge means. Basically, it just comes from the term hedge your bets. So essentially, if a lot of your money is in stocks, you would hedge your bets in something like gold, because gold often does well in and after a stock market crash. So let me just take you through it. The first thing that I wanted to look at is how did gold perform in the last stock market crash? So let me take you back to the last market crash, which happened around October 2007. That was when the snowball started rolling and stock prices bottomed out in March 2009, having crashed 56%. So October 2007 to March 2009, a crash occurred of 56%. What did gold do during this period? Okay, October 2007, gold's price was $747. At the end of the market crash, gold had a price of $934. So gold actually rose in price during the stock market crash. While your stocks were falling, your gold investment increased. Also important to note down, the year or two after the stock market crash occurred, gold absolutely shot up like a rocket. It doubled its price in just 2 years after the market crash. And let's see what silver did during this time as well. October 2007, silver's price was $13.75. At the end of the market crash, silver had a price of $13.36. So the price of silver, it didn't really go anywhere during the market crash. It just held its value. But what silver did do was it shot up ridiculously in the years after the market crash, from $13 to $48. That's a 200% gain in just, couple years. So that is something that you guys might want to note down, that these assets are a nice one to own in and after a stock market crash, especially to hedge your portfolio for when stocks do crash. And it's the reason why people like Peter Schiff recommend holding gold, because he's always talking about a stock market crash, and he knows that gold is it's a safe haven for investors to go to in times of panic. So what often happens with gold is that when stocks crash, investors panic. They look for safety. And what has been the symbol of safety throughout history for your money? Gold. And a lot of smart investors have a certain portion of their portfolio in gold for some of these reasons. And I just quickly wanted to show you why they chose to in their own words. So I'll just take you to this quality infographic by Visual Capitalist. Okay, why the world's billionaire investors buy precious metals. So first we have Lord Jacob Rothschild. You probably know him from the Rothschild family banking. Very rich man and smart investor. He buys gold for wealth preservation and a store of value. Moving on to someone called David Einhorn, a very well-known investor. He buys gold as an inflation hedge. And inflation is often high in and after a stock market crash because the government starts to print money to prop up the economy, which increases inflation, which actually gold tends to do well in inflationary periods. Moving on, now we got Ray Dalio. He manages a fund called Bridgewater Associates, and he would be considered a very risk-averse investor. he buys gold as a store of value and to diversify his portfolio. He says this: "We have a situation now where when you have too much debt leads to the printing of money to make it easier to service. So all of these things mean that some portion of your portfolio should be in gold." Anyway guys, I don't want to go through this whole article, but you get the points. A lot of wealthy investors, they like gold, particularly as a hedge for a market crash. Now gold, Warren Buffett himself, he does not use this investment strategy at all. In fact, he doesn't like gold. He employs a different strategy, and that is cash and cash equivalents. And when I say cash equivalents, I mean short-term treasury bills. That is what Warren Buffett has a lot of his investments in. And it's pretty obvious how cash can be used as a hedge in a stock market crash. Let me just take you back to the last stock market crash again, so we can use it as an example. So before the last stock market crash, all is going well. Stocks are rising, and you've got a lot of investors who think, let's put all our money in stocks. It's a risky call having 100% in stocks. What Warren Buffett was doing this time here, he was accumulating cash because he was struggling to find cheap stocks to buy, and he saw high interest rates in the treasury bond markets. And when stocks did finally crash in 2007 to 2009, Warren Buffett actually had cash on hand to buy stocks when they were cheap. His cash did not crash, his treasury bills were still earning interest. He had the perfect opportunity to buy because he was smart in the previous time period. And essentially that's why it's so important to have some of your portfolio in cash during these market conditions, because if stocks do crash, then you actually have money to buy stocks when they are cheap. If you are 100% in stocks up here, then when stocks do crash, you have nothing to use to buy stocks when they are on sale. Now Warren Buffett at the moment, he does have quite a high portion of his portfolio in cash. Now I personally don't think it's a smart move to have the same amount of cash as Buffett himself, but it is important to have some amount of cash in your hand to buy stocks when they are cheap. Now, inevitably, in a stock market crash, a recession, other countries are going to go through different phases and different cycles. And it's the same with groups of stocks as well, different stock sectors. Some sectors perform well during a recession and others don't. Now, I wanted to point you towards some industries that perform better than most in recession periods, so that you can ensure some of your portfolio is diversified into these industries. So this little graph shows the industries that perform the best in times where stocks didn't do so well. Now, note down that this was not in recession times, it was just times when stocks performed poorly. The sectors that performed the best were the utility sector, they were consumer staples, they were the telecommunication industry, and they were healthcare. Now, notice that these sectors are ones in which they are meeting a particular human need, okay? At the end of the day, humans still have needs no matter what market condition we are in. Whether it be they need electricity, whether they need food, consumer staples, or they need healthcare, their health taken care of. So maybe look at some of these certain stocks in these sectors to ensure your portfolio is a bit hedged out. And also what you want to do is look at investing in other countries, because yes, it is likely that if the US stock market crashes, the other countries will crash as well, but most countries will not crash as bad, and there will be different opportunities available. So you're not just relying on one country for your entire net worth. Now guys, you don't have to employ all four of these investing strategies. You can just deploy one or two of them. You could go more into the gold as a hedge way of doing things, which is what Ray Dalio does, as well as other billionaire investors. Or you can do what Warren Buffett does, and he looks at cash and cash equivalents. I do try to deploy all four of these strategies to ensure that if a market crash occurs, I'll be prepared.